So some people criticize the wheel strategy as like nickel and diming, you know, just collecting small amounts of premium, putting up too much money on the cash secured puts, having to own significant amounts of stock to sell covered calls against them. But let me explain something real quick. So at any given time, I have between 35 and 40 covered calls or cash secured puts, and that's because I trade 3, 4, 5 of those every single day, and they add up. And I do 2, 3, sometimes 4 weeks out. Sometimes I do leaps. So I'll have a large amount of options out there. I'll have, see all these covered calls, cash secured puts. I got a ton of them out there. I got some that are in the money. These are all covered calls that are in the money, so they're all stock that I'm going to sell. Let me download these so I can take a deeper look at them. So here they are. Here are all my calls. I currently have 34 calls and puts out there. Most of them calls. Some of them are double. See, some of them are two, so that's more. That's more like maybe a lot of them are two, so that's more like 60 covered calls or cash secure puts. And this is what I sold them for. $2,654. That's how much I received on all these covered calls. Now, somebody says 2,600. That's not very much because you're holding, a lot, tens of thousands of dollars in stock here to sell these covered calls. But remember, covered calls are promises to sell. So if they trigger, then I sell the stock and I'm out free and clear at my cost basis and I keep this. But also, this is a portfolio margin account. Portfolio margin account means I don't have to put up, for instance, I don't have to put up $4,000 for Intel stock to sell this covered call. I have to put up a fraction of that. My current margin requirement is $17,000 for all this stock. I only have to put in $17,000 to get this $2,650. So that's what makes it worth it because I use leverage. So that's $17,000, $2,650. That's about a 16% return. So all this stock, I only have to hold $17,000 in the account in order to hold all this stock and sell the cover call and collect $2,600. This is why I can stay mostly in cash because I use the leverage. I use the brokerage houses funds to hold these stocks and sell covered calls. Now the reason why 17,000 is so low is because these are high quality stocks. They don't move very much. They're not going to zero. Well, maybe Palantir. They're not going to zero, and cover call strategy is extremely one of the safer option strategies. So that's why the brokerage firm allows me to only put up a fraction of what the cost would be for that stock. And so that's how I leverage the funds. That's how I leverage to get these covered calls. So it really isn't a strategy that is nickel and diming. You can make a living off of selling covered calls, using margin, learning the levels and getting out of your trades by selling the calls at your cost basis and not actually losing anything on them. Now, all you have to do is go further out. So if Palantir drops significantly, this goes out to January 2024, and I think I sold this a few months ago. You just go out further, sell time. Instead of selling for premium, you sell time. And that's how you elongate your positions and create additional premium. So that's why I trust the wheel strategies. I've done this for 17 years. I've looked at all the strategies, and there's a couple that work really well, but this is the one I found that will consistently pay my rent.